Rezolve AI PLC is currently trading at $5.04, which is a sharp drop of 0.42 cents or 7.69% on the day. Now, a nearly 8% intraday slide like this on a recently listed company immediately catches your attention, and the easy explanation is just market volatility. But what's actually happening here is far more specific. This isn't just random selling, it's the market's brutal and immediate reaction to the difficult transition from a private company with a story to a public company that has to deliver results. This kind of price action is the classic sign of a stock caught in the treacherous crosscurrents of post-SPAC trading, where the initial hype confronts the cold, hard mechanics of float, redemptions, and the street's demand for proof. The general belief, the expectation, when you hear a name like Rezolve AI is pretty straightforward. The AI tag immediately makes you think of the incredible runs we've seen in names like Nvidia stock. The narrative is that this is a company poised to capture a piece of the next big technological wave, using artificial intelligence to reshape mobile commerce and consumer engagement. The story they present is compelling. Point your phone at anything, an ad, a product on a shelf, and instantly transact. It sounds seamless, futuristic, and highly scalable. Many retail investors, perhaps using platforms like the Robinhood app or SoFi Invest, might see the low-dollar stock price and the AI label and view it as a ground-floor opportunity for exponential growth. The expectation is that they are investing in a technology innovator that will become an integral part of how we shop and interact with brands. A story that seems especially attractive when you're looking at various investing sites for the next big thing. But the reality is starkly different and significantly more complex. Rezolve AI isn't a pure AI company in the same vein as those developing foundational models. It's a fintech and mobile commerce company that uses AI as a tool. That's a critical distinction. Its success isn't contingent on some major AI breakthrough, but on mastering the notoriously difficult game of consumer and merchant adoption. The reality is that Rezolve AI came to market through a SPAC merger, a route that has been littered with disappointments over the past few years. These De-SPACs often suffer from high redemption rates, meaning the original SPAC investors take their cash back, leaving the newly public company with a smaller cash reserve and a smaller public float than anticipated. This low float is a double-edged sword. It can lead to dramatic spikes on good news, but also creates the kind of gut-wrenching volatility we're seeing today, where a relatively small amount of selling pressure can crater the stock price. The 7.69% drop is reality pushing back hard against the hopeful narrative. It reflects the market's deep skepticism about the company's ability to execute its business plan in a competitive landscape dominated by giants like Apple stock with its integrated payment ecosystem. Looking closer at the recent market dynamics, today's sharp decline is the focal point. We have to question the volume behind this move. Is it a high-volume capitulation, suggesting that early investors are rushing for the exits? Or is it a low-volume drift downwards, indicating a lack of buyers and general illiquidity? For a stock this new and this small, liquidity is everything. Without a solid base of buyers, any selling can have an outsized impact. Institutional sponsorship is another critical factor. At this stage, it's unlikely that major funds managing Fidelity mutual funds or big Schwab Intelligent portfolios have built significant positions. They're watching from the sidelines. The early trading is dominated by retail speculation and maybe some smaller, more nimble funds. The lack of a strong institutional anchor contributes directly to the instability. Any filings showing a respected institution taking a stake would be a massive vote of confidence. But right now, there's a vacuum. This is a classic scenario for those practicing self-investing through an individual brokerage account. It's a high-risk, high-potential reward situation that requires constant monitoring. The company's sector is also a headwind. While AI is hot, fintech and e-commerce have been under pressure. High interest rates curb consumer spending, which is the lifeblood of any commerce-focused platform. If people are buying less, they're less likely to try a new way of buying. So Rezolve isn't just fighting to prove its own model, it's fighting a tough macroeconomic tide. This is where platforms like interactive brokers with their advanced analytical tools become invaluable for serious traders trying to separate company-specific weakness from broader sector malaise. Comparing its chart to an established payment processor or e-commerce player would likely show shared struggles, but the percentage drops for a small cap like Rezolve will almost always be much more severe. So what does Rezolve AI actually do? Their core technology, the Rezolve platform, aims to make any media scannable and shoppable. Imagine seeing a jacket in a magazine ad, pointing your phone at it, and being able to buy it in 2 taps without searching for it online. They use a mix of image recognition, QR codes, and other triggers to close the gap between seeing something and buying it. The business model relies on partnerships with merchants who embed this technology into their marketing materials and apps. Rezolve would then take a small fee from each transaction it enables. On paper, it's a brilliant model that tackles a real friction point in the consumer experience. It's the kind of innovative idea that might be discussed within the investment committees of Fidelity Wealth Management. However, the challenge is enormous. They need to convince thousands of merchants to integrate their system and millions of consumers to download and use the app. It's a classic two-sided market problem, and it requires a massive sales and marketing effort, which, for a newly public company with a potentially limited cash runway, is a significant hurdle. Looking toward the future, the bull and bear cases are miles apart. The optimistic scenario, the one that fuels the expectation, is that Rezolve AI signs a few key marquee clients, a major national retailer, a big consumer brand, or a telecom company. Such a deal would serve as powerful validation, triggering a network effect. If one big player adopts it, others might follow suit for fear of being left behind. In this scenario, revenue would ramp up quickly, the market would reevaluate its skepticism, and the stock price could appreciate significantly. This is the outcome many are hoping for when they start their online investment with a speculative name. The more cautious scenario, the reality of the risks, is that this adoption never materializes at scale. The company could burn through its cash reserves trying to build its network, leading to dilutive secondary offerings just to keep the lights on. Competition is fierce and comes from all angles. Tech giants are constantly improving their own visual search and payment tools. Retailers themselves may opt to build proprietary solutions rather than pay a third party. The risk is that Rezolve AI becomes a piece of interesting technology that never achieves the commercial escape velocity to become a viable, profitable business. This is the concern that sophisticated investors using the Fidelity trading platform or the interactive brokers trading systems would be modeling out. They would be looking at the balance sheet, calculating the cash burn rate, and trying to project how many quarters the company can survive without a major revenue inflection point. Comment below with your thoughts on the De-SPAC market. Do you think companies like Rezolve AI can overcome the initial skepticism? Ultimately, the story of Rezolve AI is a perfect illustration of expectation versus reality in the stock market. The expectation is a futuristic AI-powered commerce engine. The reality is a high-risk De-SPAC struggling for validation in a difficult market. Today's 7.69% drop is a painful but clear signal from the market that the story alone is not enough. The path forward for Rezolve is not about its AI algorithms or its technological potential. It is about its ability to execute on the ground, to sign deals, attract users, and generate revenue. The company has to bridge the vast chasm between a clever idea and a sustainable business before it can win the market's trust. Until then, traders and investors should expect this kind of volatility to be the norm, not the exception. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Thumbs up! Don't forget to like, comment, and share this video to support the channel.